What if the markets, industries, and risks that we think that we understand are shaped by forces we've only really begun to grasp? What if our confidence in numbers, logic, and models overlooks the deeper unseen drivers of the world around us? Energy moves economies, fuels progress, and powers our lives. But how much of it do we really control? These questions have shaped every chapter of my career, and I'd like to share what I've learned along the way. I'm Mark Roach, and this is FutureWise Energy. This is more than a platform to talk about energy markets and industry trends. It's a space to dig below the surface, to uncover the interplay between economics, people, and the forces shaping our shared future. This is a place for exploration, reflection, and connection. Over my career, I've stood at the heart of some of the biggest and most complex movements in the oil and gas industry. My work has taken me to state-owned oil fields around the world where I saw firsthand how governments and politics and people play into global energy markets. I've worked on large fields here in the United States, analyzing production, challenges, and operational efficiencies. I've had the privilege of sitting in the middle of $10 billion worth of transactions over about 8 years. And I've also raised about $1.3 billion to create and grow two successfully privately held oil companies. Alongside big wins, I've also weathered my fair share of losses. I've lived through oil price crashes, economic downturns, and moments of doubt when outlooks seemed bleak. If there's one thing I've learned, it's that the energy business is not just an industry of innovation and engineering. It's an industry of uncertainty, driven by volatile markets, geopolitical dynamics, and human emotion. This volatility is what makes risk management both a constant challenge and an essential art. The tools of risk management in the oil and gas industry are as broad as they are complex. For years, I worked on cutting-edge projects aimed at understanding these risks. One of the most defining was a massive data-driven initiative to model every oil well and gas well in North America. We created simulations, charts, and curves aiming to uncover patterns that could help predict market shifts, manage resources, and mitigate uncertainty. But for all these scenarios and this data and technical analysis, there was always more at play than the eye could see. The market isn't simply a sum of supply and demand. It's a web of interactions where competition, fear, speculation, power, and external events intersect in unpredictable ways. The blend of human emotion and broader structural forces exposes the limits of even the most sophisticated technical models. Consider hedging, one of the key financial tools that oil and gas producers use to manage risk. Hedging strategies are designed to lock in prices, smoothing out the peaks and the valleys of a volatile market. Depending on the type of instrument used, hedging can protect a producer from dramatic price drops while capping the potential upside. Instruments like swaps and costless collars provide flexibility, but they come at a cost. Swaps allow producers to lock in fixed prices, while collars create a range within prices can fluctuate, protecting against steep declines while limiting the gains if prices rise. Yet, despite the prevalence of these tools, hedging activity amongst large U.S. independents has been steadily declining. For example, companies like Occidental Petroleum and Continental Resources have moved away from heavy use of hedging instruments, opting instead for a strategy that prioritizes resilience and operational efficiency. By building strong balance sheets and focusing on disciplined capital allocation, they've made a bet that they can ride out market downturns and fully profit during price rallies. This decision reflects a larger trend in the industry where producers are choosing exposure to market volatility over the assurance of financial hedges. The potential for higher prices often outweighs the cost of limitations and traditional hedging strategies. Of course, this approach carries risks. The market's unpredictability means that even the most confident players are making calculated bets based on incomplete information and uncertain outcomes. These dynamics were particularly stark as I watched companies hedge during pivotal moments in recent years. Gas-focused companies, for instance, have leaned more heavily into hedging compared to oil producers. Infrastructure challenges and localized price collapses like Waha Hub volatility in the Permian Basin have made gas swaps a necessity for many operators. But the contrasting behaviors of oil and gas players reflect just how diverse risk management strategies can be, with each company carving its own path based on market conditions, geography, and financial goals. What's remarkable beyond the technical decisions is how these strategies mirror the human instinct to seek stability in chaos. Whether I've been in a boardroom finalizing a transformational deal or back home in the Ozarks, the conversations often sound the same. I heard executives armed with spreadsheets and legal teams speak with the same certainty as the folks in a church parking lot who've never seen an engineering report in their lives. Both groups exhibit a tendency to repeat patterns, to cling to familiar narratives, and to find comfort in stories that bring order to uncertainty. It's a phenomenon I've encountered time and time again, and it's forced me to rethink the nature of expertise, confidence, and decision making. There's truth in numbers, that much I know, but there's also truth in the unmeasurable. What runs beneath the surface of every conversation about markets, balances, and hedges is that the recognition that control is fleeting. Markets don't bend to technical models alone. They respond to the unpredictable flow of human events, the ripple effects of leadership decisions, which we're seeing right now, and the aspirations of people in every corner of the world. Oil business, the oil business, has its patterns, but they're never static. They change as geopolitics intervene and societal demand transforms. To succeed in this space, you have to stay adaptable. You have to appreciate that the tools and techniques that we rely on, from hedges to capital forecasts to production curves, are only part of the equation. The rest lies in the values we bring, the lessons we learn, and the risks that we're willing to take. This is the essence of FutureWise Energy. It's a platform built on the conviction that energy is more than a commodity, more than a market. It's a force that connects us all, shaping lives, industries, and possibilities. Here we don't just examine market trends and technical analysis. We ask the deeper questions. What drives us? How do we manage risk when so much lies beyond our control? How do we build systems that not only fuel growth, but also honor the people and the planet they serve? Over the course of my career, I've learned to live with risk, to see it not as something to overcome, but as something to engage with. I've learned to find meaning in uncertainty, to look for signals beneath the noise, and to build relationships that endure even the toughest downturns. Thanks for being here with me, for taking the time to reflect, explore, and engage here. Together, we'll keep digging into the stories, data, and forces that shape our future. May every well that you drill, whether in life or in business or in the earth, bring you wisdom and depth. And may FutureWise Energy be a guide as we move forward, one question, one discovery at a time. Thanks for watching. I'm Mark Roach. This is FutureWise Energy, wishing you all the best.